Hello, everyone. Welcome to another episode of In Conversation, my advisor coach. Today, in conversation, once again, I have a very dear friend as our guest, Mr. Raghav Iyengar, Chief Executive Officer with 361 Asset Management. Welcome, Raghav, to In
Thank you.
Conversation.
Thank you, Suren. Thank you so much. And thank you, Advisor Coach, for giving me this opportunity.
Always our
Yes,
pleasure.
yes, yes.
So, Raghav, you're launching a new fund offer on the 30th of July and closing on 30th of August,
Yes,
which is the 361 Multi Asset Allocation Fund.
yes.
So, could you tell our viewers more about what this fund is, how this fund will be different from the other multi asset allocation fund? And very interestingly, I was going through a presentation and I came across a word called the VUCA world,
Yes.
right? I hope I pronounced it
Yeah,
correctly.
it's absolutely correct. Yes,
Yeah. So,
yes.
also, could you let us know as to what this means?
Yeah, okay. I'm going to take your question in reverse order, Suren, because this product was actually designed keeping that VUCA word in mind.
Yeah.
VUCA full form stands for volatility, uncertainty, complexity, and ambiguity.
Right.
So this is a management word which is affecting a lot of businesses, and this is every time this has largely been used in the management context of managing real businesses, but more often than not, this word is used very aggressively, especially nowadays in the financial markets, because all those four components are pretty much there, right? And
Hmm.
I think what channels like yours have been able to do, especially with our partners, is bring investors to terms with volatility.
Hmm.
So today I don't get that panic call that I used to get 10, 15 years back from partners or investors when the market swings 1 or 2% here and there. And I think that's full credit to people of, all the entire partner community and especially people like Advisor Coach saying that, hey, volatility is a part of the game, don't worry. But the other three are becoming difficult to deal with, which is uncertainty, right?
Hmm.
Today there's so much of stress around this whole Trump tariffs and the way the world is shaping up to be. At this point of time, there are almost 50 plus global conflicts being fought.
Hmm.
We know the three, four big ones because they're in the news, unfortunately, for the wrong reasons. But there's a lot of side hustle happening on wars right now. Now,
Hmm.
what that impact is happening. So the world is in some sense actually a very different place from what it used to be 5, 10 years back.
Absolutely. Hmm.
We've gone from a spirit of cooperation, collaboration to a spirit of competition,
Hmm.
where in some sense it's every country for itself, right?
Hmm. Hmm.
This whole tamasha, if I may call it, how does India figure out? More importantly, how do our markets play out? Ultimately, the investor is looking for a stable, predictable return. And that's how this product construct. In fact, this is the only product in the industry which allows you to construct something like this. If you were to go to a pure equity fund, let's say a large cap fund, the regulator is very clear. You have to put 80% of your investments into the top 100 companies, right?
Hmm.
That's your set. In a multi-asset allocation, Suren, you have the ability to go across asset classes in very large percentages.
Hmm.
So I think the reason we're doing this today is one, obviously the taxation is much clearer. So I think one thing which most investors are missing out today is the fact that any return that comes to you has to be seen in the context of post-tax return.
Hmm.
There is an gross return that you make, but it depends
Hmm.
on how long you keep
Hmm.
it. Your net return has a big impact on it.
Hmm.
And there was some confusion around how multi-assets get treated, etc., which has now got sorted. I think what the
Hmm.
government has done in the last 2 years is actually really simplified the entire
Hmm.
taxation structure for
Yes, yes.
capital gains.
Hmm. Hmm.
So any product which has 36% and more in non-debt instruments, right,
Hmm.
qualifies for something called hybrid taxation,
Hmm.
just 12.5%. But only difference is in an equity fund where
Hmm.
that percentage would be 65 and above. The
Hmm.
period is 1 year. In this
Hmm.
product, it is 2 years,
2 years. That's right.
which is absolutely fine in our way of thinking
Absolutely.
because I think if people ask me, and that's I'm going to preempt a question of yours, is that if how long should one ideally keep money for? My sense is the longevity depends on investor to investor.
Yes.
But what I would recommend is anybody who comes into this product has to have a 3 year plus horizon.
Yes.
So taxation fits in very well.
Absolutely. Hmm.
Now, what this does is that it allows me to put significant amount of money to work in defensive assets. So our fixed income allocation is all the way
Hmm.
from 10 to 50%.
Hmm.
Our commodities, which is gold and silver, allocation is all the way from 25 to 40%.
Hmm.
And our equity allocation is all the way from 15% all the way up to 35%.
Right.
And we've kept a sleeve for up to 0 to 10% for REITs and InvITs, which are largely physical assets on which you are able to at points of time. And if you see the REIT index, how it's done over the last 5, 6 years, it's given you a very decent high single digit return.
Sure. So these limits have been
They
predefined.
have been predefined, put into the offer document.
I
So it's
see.
not, it's,
Interesting.
and the reason of that is also very simple. We looked at 2 year rolling returns.
Hmm.
Why 2 year? Because 2 year is the rate, is when it becomes a long-term capital gains
Hmm.
tax, right? That's your minimum holding period.
Yeah.
In flat markets, this tends to do very well, which is, and you and I, Suren, I've seen markets where, nothing has happened for 2, 3 years in equity.
Yes.
Right. So I think in that context also this product, because of the construct, because it has ability to take a significant amount of fixed income and debt and gold and silver,
Hmm.
been
Hmm.
able to give very, very decent returns to the investor.
Hmm.
In falling markets, obviously, because of its defensive nature, it obviously does very well. Now, interestingly, even when markets do well, which is in that, they go into that high teens, this product is able to capture about 75-80% of the up move, but
Right.
with one third of the downside volatility.
Hmm.
This is obviously all this has been done on the back of some fixed asset allocation, 25
Hmm.
in equity, 25 in commodities, and about 50
Hmm.
in debt, which is the index actually. But
Right.
obviously, we have
Hmm.
three very, very interesting people. Mayur Patel, who manages our equity funds,
Hmm. Hmm.
he
Hmm.
manages our focused equity flexi cap. We have Milan Modi, who manages our dynamic bond fund, a liquid fund, overnight fund, who's the fixed income manager. And we've got a third commodity specialist called Rahul Khetawat,
Hmm.
more than 15 years experience in managing commodities, especially gold and silver.
Sure.
So I'm hoping that the combination of these three gentlemen, guided by an asset allocation committee, which has Anup as the chairperson, will be able to actually do better than hopefully than the static allocation numbers which I pointed out.
Sure. Sure.
Yeah, so three reasons. I think one is very clearly, I think there is a need for a defensive product in the market today.
Hmm.
uh,
Hmm.
Across all investor categories. It's not only for retired people or people who are going into a state of retirement. It could be even for anybody, Suren, who's starting his mutual fund journey, his or her.
Hmm. Hmm. Hmm.
I think people should take cautious steps when the market is a little expensive, and that's our belief right now that markets are a little expensive, especially in the
Hmm.
short term.
Hmm.
So when they're expensive, obviously, then when the market then tends to sort of correlate to valuation.
Right.
And that
Right.
you've seen now in the last 1 year, for example,
Hmm.
if you look at 24, 25, the equity indices have given reasonably low single digit returns.
Yes.
As someone who had come into a product in equity expecting high double digit is going to get disappointed, may get completely switched off on the category.
Sure.
First
Sure.
time investor, great product. So that's the difference. I mean, it's for all investor categories because we have the ability to put meaningful amounts of money to work
Hmm.
across different segments, and more importantly, those different segments tend to behave very differently.
Hmm.
So let's say when equity does very well, gold tends to sort of take a backseat and vice versa.
Right.
Same logic happens to be for silver too.
Hmm. Hmm.
Equity and fixed income, as you know, are completely widely unrelated asset
Hmm.
classes.
Hmm.
So when
Hmm.
you have a chunk of money in unrelated product classes or unrelated
Hmm.
asset classes, your outcome tends to be much, much better, especially in times of volatility.
Sure. Absolutely. So tell me something. How many scripts stocks does this portfolio plans hold, and anything more on the investment strategy as to how do the fund managers plan to invest the money?
So on the equity side, Suren, we have an SCDB framework. Which is
Hmm.
the fund management team is our aim is to try and create alpha for the customer. Alpha
Right.
being better than index returns.
Hmm.
Right. So in that space, we are not really constraining ourselves to being only in small cap or mid cap or large cap. It's an all
Hmm.
cap portfolio, very
I see.
bottom up.
Hmm. Hmm.
We have a proprietary investment module called SCDV, which
Hmm.
stands for secular. Secular are companies which are given a reasonable high return of equity and a good PAT growth.
Sure.
And then you've got defensives, which give you the ROE element, but not the PAT. You've got cyclicals, which do the PAT growth, but not the ROE. And you've got a set of companies which do neither do both.
Right. Hmm.
Our idea is to obviously over allocate to the secular basket and then keep tactically moving between cyclicals and defensive depending on where the market is. So
Hmm.
just to give you an example, last year we were very heavily into cyclicals. Over the last 8, 9 months, that portfolio has shifted towards defensives. And obviously reduce allocations to value traps. I'm saying reduce, not make it zero.
Right.
So there are many companies which are technically classified as value traps, but which have something in play. Either the macro environment is changing, or
Hmm,
their
hmm,
business model
hmm,
is changing, or there is some
hmm,
restructuring happening which could move them towards the secular basket.
hmm, hmm,
So in some sense, this will be very similar to our flexi cap portfolio,
hmm, hmm,
where there are no constraints on the fund manager to go across market capitalization, and we have used to our advantage. So FlexiCap, as you know, is a 2-year-old fund, and
yes. Hmm,
it's largely a true to label FlexiCap. Because if
hmm,
today it's roughly about 52-53% large cap,
hmm, hmm.
and 40-45% mid and small cap.
Right, right.
So that's the way we plan to run our equity book.
Sure.
Fixed income, as I said, we have a very good dynamic bond fund product.
Hmm,
If you could look at the track record, it's been very smooth, kind of an 8% CAGR over the last 5 years without taking any credit risk. And that's
hmm,
what we're going
hmm,
to try to replicate over here.
hmm.
So largely, but of course, what we're only doing in that space is that we will not go heavy into duration. Because as you know, debt duration sometimes tends to add excess volatility to the return.
Correct.
Possibly this will be like a medium to long duration fund at the top end. In the
Hmm,
bottom end, it really is a function of what macros the fund management and the investment committee is seeing. On the credit side, we will be largely double A and above. If we get some tactical calls around A, where we see potential upgrades or where there's a
hmm.
manufacturing opportunity, we may look at it, but for a very little part of our portfolio.
Sure.
On the commodity side, largely at this point of time, the fund management team is seeing more value in silver.
Hmm,
So current market levels, maybe the portfolio will be 60% silver, 40% gold. Now,
hmm,
silver, as you know, Suren, is also reasonably volatile in terms of price.
hmm,
In fact, it mimics equity quite closely.
hmm,
So this is not a buy and hold strategy.
hmm,
If we
hmm.
feel that silver has given us what we think we are able to get out of it, we will come back to gold allocations.
Sure.
So gold will be the most stable part of the commodities piece. A silver we'll use tactically. Lastly, we also have the ability to do some level of commodity derivatives, commodity
Hmm,
arbitrage.
hmm,
There are periods of time during economic announcements or during maybe festive season where you get a very healthy arbitrage between spot and future prices, right?
hmm.
And this product has a built-in ability to capture some of that, depending on the opportunities that we get there. So broadly, yeah, I've
Right.
talked about this. 0 to 10% sleeve is there for InvITs and REITs. Again, we have some very good in-house capability to source and identify very good REITs and InvITs long before the market has actually looked at it. So if we get some great tactical opportunities there, we like to keep that. But those will also be obviously more stable returns from a portfolio perspective.
Sure. Sure. So practically it covers everything.
Everything, yeah. So we've in fact also
Equity.
requested for an overseas limit.
Okay.
That will be within the equity basket of 50
Yeah,
to
of course.
25.
Yeah.
Obviously, right now, as you know, Suren, there is no immediate limit available.
Right.
Please
Right.
someday, if wherever limits are available, the overseas stock position is also built into the offer document. There is
Hmm.
a
Oh, there
program
is.
to
Okay.
invest
Hmm.
up to $100 million in overseas
Hmm.
equity.
Hmm.
But right now, obviously, when we start off with, there are no immediate limits, so we'll start off with domestic.
So it has equity, it's got debt, gold, silver, InvITs, REITs, and going ahead, international equities as well.
Yeah.
So
Yeah.
pretty much,
Everything that you can
it has
possibly invest.
everything.
Yeah.
Excellent.
And more importantly, in meaningful quantity.
Yes, of course.
So
And with
you
three,
asked a question was what's the difference between this one and most multi-asset funds? Most
yeah.
multi-asset funds are equity plus debt plus gold,
Hmm, hmm, hmm.
and where the heavy lifting is actually done by equity.
That's true.
Nothing wrong in that thought process, Suren, because equity has been a brilliant. It is the
Hmm.
best compounding
Yeah,
asset.
but we of course have to look at the times when
But you have to
markets
look at times, yeah. And if
went
you're really
sideways.
looking at an investor who's looking at this product is really looking at investors who are happy to reduce their return, but for predictability.
Sure.
So hence the equity portion of this product is much lower than maybe many of my peers in the business.
Absolutely. So, Raghav, since you're launching this multi-asset allocation fund, obviously what we all have observed is that multi-asset as a, as a strategy, as a client portfolio as allocation has become very, very popular in the recent
Yes,
past few years. So,
yes.
what, according to you, are some of the reasons behind that?
I think three things. I think one is most people come in thinking that they can construct a multi-asset portfolio very easily.
Mm,
It's proving to be a bit difficult, Suren, especially nowadays in a VUCA environment. It's very, very difficult to predict which is the next winner in which asset class at what time.
mm,
Number two, obviously, the taxation implications in terms of post-tax are quite large today.
mm, mm.
So there is a very large difference between short-term and long-term.
Yes.
Number three, I think people have also seen that, now that you've got a very long track record of both equity and gold
Mm,
available to you in as an investment,
mm,
people have realized that there is some sense in moving some part of a meaningful part of your portfolio
mm.
towards gold and silver. Silver is, of course, the latest addition. But
Yes.
so if you ask me, investors have been looking at a multi-asset for diversification.
Mm,
Initially, I think people, yeah, of course, if you're in the hands of a very capable advisor or you're a very smart person and you have all the time in the world to look at data and take decisions, you can construct a multi-asset pretty much on your own. But for people like, let's say, me, who's a lazy investor, I'm very much a fill it, shut it, forget it guy.
uh,
I look at my portfolio rarely, maybe once a year I try and do that. This is an ideal product class because then I've got a set of three experts who are actually managing the portfolio for
mm,
me and
mm.
taking the right calls, hopefully, between the right asset classes.
Sure,
So I
sure.
think that knowledge is now trickled down to many more people. Number two, obviously, there is now result availability. So they're
Mm,
very clearly today, you can see how multi-assets, especially assets which have got a sizable allocation to commodities and debt, how they
mm.
do in adverse equity situations.
Sure. Mm,
Lastly, I think also people are comfortable doing this in a slightly predictable format like what we are doing today. Because I think the realization is, hey, if we want to do equity in a multi-asset, we'd rather do that on our own.
right.
Yes, I don't need to worry about 60 to 80%. I can do 80, 90% also
Mm,
and
mm,
then manage that, right? So, I mean, then you might as well do the equity bit on your own,
mm, mm,
construct your own portfolio 70,
mm.
80%, and
Right.
put the rest of it into whatever asset class.
Sure. So, tell me something in terms of Raghav, what have been some of the new distribution initiatives, at 361 Asset, uh, maybe for the Xenopho or what you've
Uh, I
taken in
think what
this
we're doing
space?
is that a lot of co-branding possibilities, sorry.
Mm,
So I think very importantly, I think we have a nice presentation which outlines all the things that I've
mm,
spoken about
mm.
in a very concise way, maybe 20, 25 pages. We've got a very crisp one pager, which again talks about how we are going to do what in this product. So it's a very easy read. So those are obviously immediate wins that, anything that we can do on co-branding with our partners, very happy to do.
Sure.
The other thing is, of course, I think I've also realized the power of, I think obviously it also gives us a chance to go across the country, meet a lot of our partners face to face. And
True.
it's my firm belief, Suren, that when things, especially markets, are not great, I think that's the time that AMC business people should be on the ground.
Right. Right.
When things are doing very well and the market's giving you double-digit returns, frankly, it's at that point of time, my feeling is you just leave the partner alone. Let them do their business. They do it
Uh,
much better than me,
uh,
at least. But when things are not great, I think that's the time you have to stand up and sort of give them that confidence that, the calls that they are taking are in the right direction. Because I
sure.
think, especially MFDs are very, very pro-client.
Mm, mm,
And I think they really don't feel good if their clients don't make a good return.
sure. Sure.
And there are periods of time where that is going to happen. And you know it, and I know
Mm,
it. Equity
mm.
markets, especially, are definitely not in our control.
Never
And
been.
so I think that's the time that you need to actually. So this NFO gives us a chance as a team to really step out
Uh,
and really do some all India coverage. It also helps me, Suren, from my perspective as a selfish personality, we've opened about 7 branches in the last 1 year, 7 new
mm,
locations and seven
mm.
or eight. So we want to, sorry, 8 locations. So we want to actually, this is a great way for me to go in and address partners in those particular
Sure,
locations.
sure, sure. Tell me something, Raghav. Any major changes you found in the way distribution at the ground level is operating? If you could just highlight a few which come to your mind.
I think one thing which is common across the country, Suren, is adoption of digital.
Hmm.
I think very clearly today, whenever and I mean, you and I both have done this before, so you will appreciate what I'm saying. Typically, an NFO the demand for stationery is very, very high, especially application forms. For me, this time it was just statutory.
Yeah.
We did print, of course. We
Yeah.
had to because there are a set of people who yet like filling things on paper, especially senior citizens, and so we have to do that. But most of my partners are very happy to be paperless, if I can
Yes.
use the word.
Mm,
Whether it was forms, whether it was my presentation, whether it's
mm,
a one
mm,
pager.
mm,
And obviously, if they are doing it, then that means their customers are really looking
mm,
at it,
mm,
right?
mm.
Number two, I think very clearly people are happy to look at new fund houses or
Mhm.
fund houses like ours, which have been around for a long time,
Mm, mm,
wanting to engage. I think that that openness is very much there.
mm,
Yeah, obviously, the larger fund houses do have a huge brand value to them. They have much better infrastructure. But the openness with which we were received, especially in a product like this,
mhm,
very, very surprising to me, Suren. And I think that stands out for the MFT community.
mm,
That if there is a new idea, you got a sensible set of people backing it, there is some relationship on the ground, people are very happy to engage.
mm, mm,
Unlike in the past where there used to be like, no, I just don't want to work with, I want to work with only the top three, four, five
mm,
guys.
mm, mm,
I'm not really keen to go expand my list. Here, that's
mm.
not the case. I mean, if you got a different product idea, which is slightly different or materially different from what's there in the market, please come and talk to us about it.
Absolutely.
I mean, if you're doing the same old wine in new bottle, I think people are smart enough to say,
Yes.
no,
Yes.
we will
Mm,
then stick with our established partners. But if you're doing something different,
mm,
it makes sense from a client perspective. Very happy to
mm.
have that conversation.
Absolutely.
Number three, I think there is a massive, I think now people have really become very, very conscious of post-tax returns. I think
Mm,
much more now, especially given all the tech upgrades that have happened in the income tax department.
mm, mm.
I mean, today, thanks to Aadhaar PAN linking, any income of yours is going to get spotted and then obviously
Absolutely.
materially taxed, right?
Yeah.
So I think people are now very conscious of the fact that, hey, we need to uh, be aware that what you're doing to the customer is not the gross return. Our job is also to try and give him the best post-tax return.
Absolutely.
So again, products which have that ability to deliver for the customer is something that distributors are really looking at. And lastly, of
Absolutely.
course, wearing a very different hat from what I'm speaking for the last 15 minutes is that people are very open to looking at alternate products.
Mm, mm,
That's been my experience in 361. I've spent about
mm,
a year now in this place, and
mm,
I've always had this, maybe call it my personal mental roadblock, that the alternate space is largely reserved for the wealth plus kind of people. The larger banks, maybe wealth management outfits. I don't think that statement of my thought process was correct.
No, it's changing. It's changing
Indeed,
rapidly.
there are lots of very, very smart
Mm,
MFDs today who have
mm,
one access to clients who need alternate products, either CAT
mm,
2, CAT 3.
mm,
Like just to give you a sense, Suryan, we are in the process of raising what I called in my own limited English way a crossover fund.
mm,
70% listed, 30% unlisted.
mm,
We
mm,
started getting into market in January
mm,
and we've raised about 300 crores roughly in that fund, which is
mm.
okay. It's a good, nice, slow way of getting things up. And and more than 50% of that is actually my MFD friends contributing.
Right.
In
Absolutely.
the past, when we would do a product like this, we'll go to three, four wealth houses. They will do something, and within about 6 months, you will raise your 500 crores.
Yeah.
It's very limited MFD participation,
Absolutely.
maybe in
Mm,
single digits. This one, I can see that meaningful difference.
true.
I think they're also wanting to give this product to their customer.
Mm, mm,
There is a apprehension to give pure unlisted funds because of valuation, because of liquidity. So most of my MFD friends have found the EUF4, our Equity Opportunities 4, to be a great idea
mm,
to take to customers saying, hey, this is a bit of both. You get the ability to see 361 listed capability, which is already visible to you. We have 11-year track records in some of our equity funds, so that's very visible.
mm.
Number two, you also get some exposure in it through an institutional way to unlisted products.
Absolutely. Mm,
Where Suren, more than me, that the valuation, the pedigree is very, very important. And of course, that's an area where we have very, very strong expertise because our alternates asset management business is possibly amongst the largest in the country in that space.
right. Of course.
Right.
Yes.
So I
Absolutely.
think that marriage is a very good story. So
Mm,
I think the partners are happy to do all the three, right? So
Yes, yes. I think the investor is reading so much today, all
yes, yes,
digital,
yes.
and of course the mutual fund distributor advisor, he's also very, very wanting and open to, diversify, understand something new, do something
True,
new for the client,
true.
and industry as well has become very, very meritocratic.
Correct.
And
Yes.
I think collectively, with all the highs and lows which we all have seen together as an industry, as a collective pool, what we all have learned, is that it's better to go slow in the right direction than to go fast in the wrong direction.
True. Absolutely.
Analyze and, be analytical, etc., and educate and take it forward. What is
True.
good for the investor. So,
True.
Raghav, through this in conversation, what one message would you like to give about 361 asset management and about this NFO in particular to our viewers?
So I think on 361 asset management, we will do something. We will get into product areas where we feel we are able to add some value, Suren.
Yeah,
Case in point is this NFO.
you're right.
Very easy for me to have taken our equity pedigree, done an equity related math. Maybe I would have got more acceptance, maybe collected a little more money. But the idea really behind this was how can we provide a fixed income plus experience with good post-tax returns to the customer in
Yeah,
the current product construct. And that's
yeah.
how this product came out. So for me, it's a one of a kind. I think if you ask me, this is an anytime product. It
Hmm.
satisfies various investor demands. A first-time investor can come in. Somebody who's looking to build retirement corpus can come in. Somebody who has a large financial commitment in the immediate future, three
Hmm.
plus can come in. And then more importantly, even an aggressive investor can come in.
Can come in. Yes.
Interestingly, this a partner only told me. He said, I have a set of customers sir, who are 80% into equity.
Hmm.
Now that 20% is sitting in a not a very, very great place from a post-tax basis. I
Hmm.
can shift that money into this. I said, yes, you can.
Hmm. Hmm.
You can do use this for SWP. So in some sense, this is a great solution oriented
Hmm. Hmm.
where I think thanks to the product construct, a lot of use cases can be built around this.
Hmm. Hmm. Absolutely.
So I think, and obviously, support of the partner community is essential in the NFO. Obviously, we want to get it off to a good start. But more importantly, this is something, Suren, that I want to use this a 24 by 7 by
Hmm.
365 fund. And even in volatile situations right now, market at some stage, markets will get back to fairy tale mode. And even then, I believe this product has a very, very strong relevance in investor frameworks.
True.
I think so. If you ask me, this is an evergreen product idea, and that is
Hmm.
what 361 will try and endeavor to bring to you.
Sure.
Something which is very different. A lot of innovation will happen on the unlisted side because I think that's where a lot of the value is getting captured. But also, and like I said, a crossover between a listed unlisted space. Those are
Hmm.
areas where we have strong capabilities and we can bring some value to the table. And things like this, which are very, very different solution-based ideas, is what we're really looking to do here.
Sure.
So the idea is to obviously work with a set of people who share that common vision that how can we keep adding alpha to the our investor portfolio.
Sure.
And I think that's important because I think I think there are a lot of investors now, Suren, who have now come up the curve.
Hmm.
So the same old dialogue of doing a sip every day is a great habit, and it
Hmm.
works very well for new investors. But for older investors, if you're going to keep doing the same sip story, I think there's a good chance that the customer may not find you very relevant.
Hmm.
So
Hmm.
if you want relevance in various asset classes, I think 361 is a place to go to.
Hmm.
We have experience across listed equity, listed debt, unlisted equity, unlisted debt, and now in real assets too. So it's a very broad-based fund house when you think of it from that perspective.
Sure. Wonderful. Wonderful. So, well, for our viewers, this is Mr. Raghav Iyengar, Chief Executive Officer, talking about the new fund offer of 361 Multi-Asset Allocation Fund, launching on 30th of July and closing on 13th of August. So, Raghav, thank you very, very much for joining in
Thank
and,
you, sir. Thank you.
and taking us through, what this fund is all about, the interesting differentiation of this fund, and we wish you all the best for this new fund offer.
Thank you, sir. Thank you very much. Thank you, advisor coach.
Thank you very much, Raghav.